Hope you are all doing well and enjoying the festive season. I'm Sriram Subramanian, and it's truly a pleasure to host today's session. India Bonds, in proud association with NISM, is absolutely thrilled to welcome our esteemed speakers. Today, with us, we have Dr. Kapil Shrimal, an associate professor at NISM, bringing over 16 years of invaluable experience in academia. We are delighted to welcome Mr. Vishal Goenka, co-founder India Bonds. With over 20 years of experience in fixed income, currency, and credit markets, Mr. Goenka has held significant roles at various global investment banks such as Deutsche Bank, Merrill Lynch, RBS across London and Singapore. Today's session is going to be very interesting as our experts speak on the topic how to build a bond portfolio. And also, we'll also understand some strategies involved to build a well-diversified, well-balanced portfolio. And with that, warm welcome to our panelists, and over to you.
Thank you, Shriram. A big welcome to all our audience. It's a humble effort to talk to about bond investments, something which is really growing in a lot of flavor, given that the big passion equity markets have not been doing much in the country since last 1 year. Just a couple of housework things. You will get a certificate in 2 to 3 days' time after you've attended this webinar. It'll come directly from NISM. We will run through the presentation and basic fundamentals, but if you have questions, we'll have a good Q&A round at the end. Try and save your questions for later, and type questions in the middle if you feel like, but we'll be able to address at the end. So really, welcome again, and let's start this session. Just a word of caution. This content is for educational purpose only. The views expressed are personal. Should not be a recommendation to buy or sell. You should always consult a financial advisor before investing. And I can see a lot of people are saying a lot of people have invested in bonds, but we get repeated questions on this one. So let me just start. Investing in bonds. Bonds have no lock-in period, are tradable on the exchange. These are what we call myths about bond investing for people who have not invested. You need a demat account for investing. Any existing demat can be attached. When you make a payment for a bond, your money goes directly to the clearing exchange. It does not come to any platform. And the National Clearing Exchange credits the bond in your demat account. All interest payments of your bond and on redemption, money is paid directly to the issuer in your bank account. Again, it's like an equity. The dividend comes directly from the company. Interest comes directly from the company. For taxation, there is a 10% TDS on listed corporate bonds. And interest income is charged at your tax slab rate. Any capital gains are charged at the long-term capital gains of 12.5%. On most platforms, including ours, KYC is digital, and there are no charges. Let's move on. These are the FAQs. Today, we're going to cover basics, types of bonds, ideal investment portfolio, bond investment strategy, pitfalls to avoid, and benefits and Q&A. Over to you, sir.
So thank you, Vishal. Again, good afternoon, everyone, and welcome to this webinar. So I'll just start with the very basic what bond is. So bonds are the instruments which are issued by the company generally known as the issuer or a borrower. As per the SEBI regulation, the face value of a bond is 10,000 rupees. And when bond is a plain vanilla bond, company generally pays a fixed coupon. That coupon is known as the interest. The coupon can be paid monthly, half yearly, quarterly, annually, depend upon the nature of the instrument. Once the bond will be issued into the market, compulsory the bond has to take the rating from one of any rating agency. So again, we'll discuss detail about the rating. But yes, the BBB minus will be non-investment graded bond, and AAA is the highest rated bond into the country as per the corporate bonds. And bond is having a maturity. So at the time of maturity, company will pay the principal back to the investors, and till maturity, the coupon will be paid to the investors. So this is a simple cycle of a bond, taking a loan from one person, giving an interest and the principal back to the another person. So this is a simple cycle of the bond, and very simple instrument that we can say to understand.
Yeah, just to add on, when people say bond is a loan, that's it. You have given a loan to a company or a government. And as Sir said, these are the essential points to note. We will cover some of these as we move ahead. But the idea today is about portfolio strategies. So we'll not go too much in depth.
So now coming to the various types of the issuers who issue the bonds into the market. So there are two basic segments. Number one is the government. Government bonds are generally known as 𝐒𝐸𝐸, state development loans. If the central government issue the bonds, it is considered as 𝐒𝐸𝐸 or dated securities. If the state government issue the bond, it comes considered as state development loans. And the T-bills, weekly basis, Government of India coming with an auction of the T-bills. So they're the money market, very short-term instrument, maximum the period of the 364 and minimum 91 days is been issued in the market. Second type of issuers are the corporate bonds. So a part of the government, if any of the corporate issue the bond, that comes under the corporate bonds. So first will come the state guaranteed bonds. So any state PSU issue the bond or bond is issued into the market where the guarantee of the state government is there. It is known as a state government guaranteed bond. Any PSU, like the if we take the IRFC or Railtel or ONGC, so central government PSU issue the bonds, so it's a PSU bond. Banks also issue the bonds into the market. It's generally known as the subordinate debts, and NBFCs also issue the bonds into the market. A part of the some of the corporates or a part of the PSU, any other corporate issue the bond, they comes under the category of the corporate bonds into the market. So two basic segments that we can say. Next. Now, when one invests into the bond, always there is a myth or a confusion into the mind. Is the coupon or the yield is same? So both are the different. Coupon generally pays a frequency at the fixed rate of interest is coupon is there. So if the coupon, let's take an example, if the 1 lakh rupees bond is issued into the market with a 10% coupon, so coupon will be paid 10,000 rupees might be per annum to the investor. So it is a fixed till the maturity. But yield to maturity or yield varies. So yield is actual return that we can say if you invested, let's say 90,000 rupees in a bond, you are receiving 10,000 rupees coupon every year. And again, you are going to receive principal amount of 1 lakh rupees back. So difference between 90 to 1 lakh rupees plus the coupon you received, that is a yield. Yield is actual return in simple terminology, because most of you might investing in the mutual fund. So you're seeing the word terminology known as IRR or XIRR. So yield is IRR or XIRR in simple terminology. We can say it's actual return that you are going to get from the investment in the bond.
Yeah, just to add, Kapilji, I think the coupon is fixed at the time of issuance, which is the interest rate, but the bond prices can move up or down, and depending on where you invest, that's where your yield to maturity or returns are calculated.
Yes.
I'll probably take this. So people get confused with credit rating. Like you have your personal rating. Credit rating are agencies like CRISIL, ICRA, which are regulated by SEBI. And they give ratings to all issuers, AAA being the best, and in investment grade, BBB minus being the lowest out of the 10 ratings. It's very simple. If a company is regarded very highly or very high rating, it'll pay you less interest. AA plus will pay you a little more interest, AA minus onwards. We highly recommend individuals not to invest in BBB minus. They are the riskiest part of investment grade, and really, specialists or credit specialists and institutions should invest. So I know sometimes it looks very attractive, 13%, 14% interest, BBB minus. Really discourage unless you're a champion and you have done your credit analysis properly. That retail should avoid the riskiest part of investment grade ratings. This just gives you an idea, because investment in bonds should be as per your risk appetite. This gives you an idea of the current yield. So government securities are yielding 6.5%, 7%. AAA corporate bonds are AAA and AA plus are around 7 to 8. And this is how you move. Single A starts giving you 10%. BBB, which is BBB plus, BBB give you, 11 to 12 to 13%. And again, BBB minus and below, we highly discourage individual investors to invest. But this is a good, the first pulse check, to check the rating of the bond is very important on the corporate bond. And this is not guaranteed or anything assured, but it gives you an idea where is it in its strength.
So now, when we design the portfolio for bonds, ideal asset allocation that we can say investment of a portfolio with various allocation cards. So again, this is disclaimer. We'll say this is the ideal. It is not a reference or not a suggestion from our side, but generally when it's showing to the market, up to the age group of 35, so it's been young, you can say. So you can put the 70% of your portfolio into the equity, where you can take the appetite of the risk is very high, risk appetite is very high. You can definitely take a risk into the market. So 70% of a fund should be in equity. 20% at least should be in the fixed income to hedge the risk, because equity is having the various volatility into the market, and 10% to other alternative assets classes are available, like the gold or other asset classes you can take. As you become older, after 35, the risk appetite will go down. So your equity portion should reduce from 70 to 40%. So you have to reallocate your equity to the fixed income part. Here you can add real estate, because as a part of the investment, one of the asset class one can see is a real estate. Fixed income will increase from 20 to 25, and again, alternative will increase the 10 to 15%. So you have to, as the age grows, you have to reduce your equity portion for the better diversification that we can say, and for minimizing the risk that we can say. Next. So again, one interesting data, if we can show to you, always it has been there, why bond or why not equity, or why equity, why not bond? But these are always a point of discussion. So we have made a very simple example of returns of the bond versus the Nifty 50 over the period of last 4 years. You can see Nifty 50 returns and the 10% coupon bonds in last 4 years, almost same, not same, even the bond return is slightly higher than the Nifty 50, you can say, over the last 4 years. Even after COVID-19, we have seen the V-shaped growth into the equity market, but the growth is not as a part of the 𝐒𝐩𝐞𝐚𝐤 growth is not there. And you can see certain ups and downs always there into the market, but bond has constantly gone up, and in the last 4 years has given a positive return as compared to the Nifty 50.
Yes, sir. I'll just add on to it. So Nifty 50 has aggregate returned around 42%. And if you were to buy a single A or double A minus, and again, we do not advise triple B minus, a 10% coupon bond and reinvested that coupon, you would have made 46% without the volatility, without anything. The only reason we've highlighted is that both bonds and equity should be part of your portfolio. Can we move on to the next slide for the last 12 months? Yes, sir.
So in the last 12 months, again, you can see the drastic change in the Nifty return and bond return. You can see the Nifty has given almost negative 2% return in last 1 year, whereas the bond has given a positive 10% return to you. So again, as a part of the portfolio diversification, the risk is there in equity. You can hedge your risk by investing into the fixed income to minimize the risk. The moderate return can be there. And you can take the advantage of the market downfalls where the newses are negative into the market. Next, please. Yes.
So now we talk about portfolio strategies and bond investment strategies. So a lot of you are already bond investors, but actually, like in every asset class, even in equity, you don't only buy one equity, right? You have a bunch of equity. You have small cap, mid cap, large cap, sector wise, and that portfolio effect comes into play because a single story can be good or bad. Bonds are not that volatile, but still we advise or suggest that there could be various strategies depending on your life goals. So one is simply the ladder strategy. It's very simple. If you have, let's say, 5 lakhs to invest, you buy different maturities of bonds. You buy 1 lakh 1 year maturity bond, 1 lakh 2 year maturity, 1 lakh 3 year, 4 year, and 5 year. Now, what happens is interest rates can move up or down, but you're never caught in that because part of your investment will come back after 1 year. So if the interest rates have gone higher, you can reinvest at a higher rate. If it has gone lower, it's good you invested early and you can again invest at that current rate. So this hedges you from what we call market risk of interest rate, volatility or change of interest rate. The second thing it does that, you get a lump sum every year. So let's say next 5 years you get. So it may be that you actually need that money for something else, or you may decide you allocate less to bonds or invest somewhere else or buy something. It gives you that flexibility. So always make sure that your bond portfolio runs through various maturities, and whenever they mature, they give you a good current option to reinvest. Diversification. So bullet strategy is what we call is about life goals. So when people say, okay, I want to send my children for education in 3 years' time, I want to buy a motorcycle in 4 years. I want to buy a house in 5 years. And I want to keep the money aside. Highly discouraged to put in fixed deposits or current accounts of banks because they give you very little. What you should do is target maturity investing, right? So if you have, let's say, a target in 10 years, you buy a 10-year bond, or let's say 5 years. 1 year later, you buy a 4-year bond, then you buy a 3-year bond. So you make sure that you get a nice lump sum for a big event. Could be a wedding, could be education, could be buying an asset. So this helps you to achieve your life goals by staying in a less volatile asset uh, and also earning you some interest. This is called a dual maturity or a barbell strategy. It's like the weightlifting barbell. This really depends. So, we feel that we are in a reducing interest rate cycle. When interest rate goes down, bond prices go up. So you should actually buy, 2 to 3 year maturity high yield bonds, 10, 11%, which is giving you good carry. And you should buy 10-year plus government securities. So let's say this is my personal opinion, not an advice, but interest rates globally are going down. In India also, they've gone down by 100 basis points and they'll go down further. What happens is that the government security is risk free, right? And if interest rates get cut, you have nice capital gains. For example, last year, if you bought a 10-year GSEC, actually you made 12% return. You must have bought the bond at 7.1, 7.15, and the market currently at 6.5. So you've actually made 4 or 5% of capital gains on a risk-free government security, plus the 7% return, right? So you made double-digit returns. And in a reducing interest rate cycle, this barbell strategy is very good because you're taking less credit risk and little more market risk given the long-term view. Again, this is market timing. As I said, interest rate cycles move in 2 to 3 year cycles. This is a historical thing of how interest rates or government bond rates have moved. Yeah, if you can time the market, if you're really studying, reading newspapers and talking to people, usually global interest rates moves earlier than what we do in India. So if US is cutting and US is the benchmark for the world, usually rest of the emerging markets follow. Obviously, the exception was 2023 to 25. US rates went up and down, and India remained flat because the economy in those 2 years was very strong, as reflected in the equity market. But now I think with the further rate cuts in the US predicted, India rates should also come down.
So
Kapil,
yes,
over to you.
yes. So now coming to the bond portfolio strategies. So as we told about the ideal portfolio of a bond, now amongst the bond, whatever the size of bond you are holding, so which bond should have what type of investment in your portfolio? So as Vishal just discussed, there are the investment graded bond, there are non-investment graded bond, the triple rated bond, triple B minus rated bond, something like that. So among the bond market, the investment grade bond that we can say up to the A category bond, you should have the 40% weightage in your portfolio among the bond as a part of the triple A, double A or A rated bond, where the interest is up to 10% is there. Then 20% weightage should be given to the high yield bond, where the bond yield is more than the 10%. So it can be the A minus or triple B rated bond. So where the yield can be, let's take the example, 12% or 11%, depending upon the market. So it is one of the part. Again, long dated GSEC. So GSEC weightage should be 20% and 20% should be given to the fixed deposit. Again, fixed deposit is not considered as a fixed income security, but as a part of some point of time, you will say about the liquidity or some part of your own satisfaction of investment. Generally, the persons can invest in the FDs also. So this is again the strategy that one can form between the risk and return trade-off, because each of these bonds have the different types of liquidity, different capital gains, and different types of what we can say the risk associated into that. So you can take your own decision, and it should be ideally it should be look like this. So not 100% amount. So just like equity, don't put 100% money in the one equity. So don't put 100% money in the one type of bond also, that we can say. So now again, pitfall to avoid. So what are the red flags when you are investing to the bond? Number one, unregulated platform. That is the most important part, because when you invest into any bond or any of the security with unregulated platform or unregulated market, always you're carrying a risk of liquidity, carrying a risk of default, carrying a risk of fraud. What are the types of risk? You can say the risk is there. So don't invest into the bond with unregulated platform. Again, one more part, that is a unlisted bond. So in the market, you will find some of the bonds might be unlisted. If the bond is unlisted, the biggest risk is the liquidity of the unlisted bond will be there. If the unlisted bond is not going to give you the coupon, again, there is a problem for you. No maturity, again, there is a problem to you. So there is no regulatory of unlisted bond. So don't invest in unlisted bond. Again, high yield. So when you take about the expectations of the return will be very high, or the yield is very high, the chances of default can be there, because the high yield bond will always the low investment graded bonds or low credit rating bonds with the BBB minus or BBB, or you can say some point of time C also, where the rating is very low and the yield is very high.
Yeah, sir, I'll just add on to it. High yielding bond investment is good, but people a lot of times say, hey, 15%, let's go. And people sometimes do not check it is unlisted or it's a BBB minus or even BB. So don't get, attracted only by that. Just make sure the other regulatory things are in place. Sir, back to you.
Yes. Yes. So now, in the market, when the rapid yield is increasing, so always be aware with the rapidly increasing the yield, it might be due to the various information asymmetry, or it can be due to the any market loss, or any of the other concerns will be there. So you have to make aware when you are investing in the bond, if the market yield is rapidly changing or increasing, it will be risk for you. Again, SEBI regulatory process is there, so you have to be very cautious about that. There is a regulatory where proper registration of a company, proper platforms must be used. Those who are regulated by the SEBI, it should be required. Again, the rating downgraded. So you have seen in the past some of the bonds is suddenly downgraded from AAA to D or something like that. So always you have to do your own due diligence before investing. And whatever the downgrading is done into the rating, what are the cause of that, you have to understand. And again, you have to thoroughly go with all the information related to rating part.
Kapilji, maybe I'll add something. So on the rapidly yield increasing, the point is that you'll see a bond offered at, let's say, 13%. Then suddenly 1 week later, you say, no, it's 13.5. Sir, it's become really cheap at 14. I can't name the companies, obviously, and suddenly it's at 15, then there's something wrong, right? So just be aware. If rates improve by 20, 25 basis points, that's fine. Regulatory processes, a lot of websites will write, we follow SEBI regulatory process. That means nothing, which means they're not SEBI regulated. They are probably using SEBI's name to confuse the investor. And SEBI, believe me, is actively monitoring all this. So whenever someone says that, they'll actually go and call these companies. So do not get fooled if it's written SEBI regulatory process. All SEBI regulated entities have to put on their website their registration number, the exchange number. So please look out for that. It's your money. Yeah.
Yes. So now, when you strategize a bond, when you create a bond portfolio, what are the benefits in the bond investments? Number one is a risk management. As a diversification theory is there, always you can minimize your risk by diversification into various investments. And we have seen the graphs also, where we have done the relationship of the returns of the Nifty with the bond market. So always the risk management can be done through the proper diversification. You can also hedge the interest rate risk. If the interest rate will go up or interest rate will go down, how to hedge your interest rate risk by investing into the bond market, that you can do. Number two, optimization of returns. So maximizing yield or yield stabilities are there. So when you do the optimization theories of how to optimize the returns of a bond with the proper diversification, we can say. So you can create the proper diversification with optimization of a returns, not very high, not very low. It can be somewhere optimized between the high and low as a part of the swaps of the bonds you can do. Again, you have the flexibility of investing to the bond by adapting the various market condition strategies, like the market timing allowed to adjust the portfolio. Also, if interest rates are high or interest rates are low, or the economical condition of a country. It will help you to strategize what are the market condition, and you are flexible to buy and sell the bonds according to that. Then again, it's opportunity of gain also. So you have the opportunity of capital gains also in some point of time when you apply it into the bond, and it will be there. Then another benefit is the liquidity management. So strategies like the ladder or the various cash flows are given to you, various maturities you will have, amortized bond, you will have the various maturities. So it will provide the liquidity to you, and you can strategize the future cash flow with the proper timelines, you can say. Again, you can enhance the portfolio stability by reduce the volatility into the bond market, predictable incomes. So whatever the incomes are there, because if I invest into 10% coupon bond every year, I'm going to receive the 10% of that bond face value is a part of coupon. I can reinvest it. I can use it for the other payment channels, and that can be stability will be there. And tailored risk return portfolio, like combine different strategies. You can combine the ladder with the barbell or different strategies which allow the balancing of a risk into the market, and based on your own preference you can do basically part. So these are the various benefits of strategized bonds, we can say. Again, something whenever you're investing into the market, it comes with the risk is always there. So these are the major risk when you are investing into the bond market. Number one risk is the liquidity risk. So if you invest into the low rated bond or unlisted bond, always it is a challenge of a risk for you. It is not available, that the buyers are not available in the market to buy the bond, and you're not able to liquid your amount. So when you're investing into the bond market, you have to understand what is the liquidity risk associated into that particular bond. Number two, the fraud risk. If you'll go with the unregulated platform or the platforms which are not regulated by SEBI, or any platforms which are not we can say investor friendly, so you're coming with the fraud risk always into the market. So you have to be aware that you should invest into the regulated market. The biggest risk into the bond market is the market risk, that we can say when the interest rate will go up or interest rate will go down, there will upside risk or downside risk is there depending upon the interest rate. So market can be interest rate can be the movement of the country economical policy. So you can see last week the Fed is reduces the interest rate by 25 basis points. So what will impact on the bond prices? The interest rate will go down, the prices will go up. So there is a seesaw relationship between the price and the yield that we can say. So you have to understand when the market risk is there, what is the risk associated in the investment of the bond, and the credit risk is the most important part. At the time of maturity, if the bond is not going to give you the principal amount or the coupon frequently, the credit risk is involved. Suddenly, AAA rated can be degraded to D, or AAA to A minus. So what risk is creditability part is there. So you have to understand default risk or credit risk is also associated into the bond market. So although we can say bond can be safe, but risk is associated as a part of the investment. And if you do the strategized investment, that you can minimize the risk based on your own capabilities and caliber of the market understanding.
Yeah, I just added on, there is no free lunch, nothing is risk free.
Yes.
But there are certain fraud risk is, company can fraud, credit risk is similar. So there's just one to highlight, since we're talking about portfolio on India bonds, there is a feature called bond case for people who are first time, who say, I don't want to choose 5 bonds. You can choose by various strategies. They're high yielding monthly income. I saw there is a question, if my purpose is to generate monthly passive income, there are a lot of bonds which give you monthly coupons. So it helps you to match your EMIs. You can create a portfolio only of monthly income bonds. And you can select this. This is not advice. This is a choice of selection. But you can make one payment to buy 5 to 7 bonds. It's very, very easy. It's been created for people to create instant portfolios, who says, okay, I want to diversify and create instantly. You can visit this feature. Let's go next. Okay, that brings us to the end. We have a good Q&A lined up. So in the Q&A box, you can start typing your questions, and we'll be very, very happy to answer that. Kapilji, one important question which has come is, can I sell my bonds at any time? Yes, you can sell bonds anytime. Bonds are tradable instruments. Usually, there is a bid ask or liquidity. There is also a process that you have to follow, which is about a DI slip, a delivery instruction slip, I can tell my audience, our audience, that we are working with the regulators to do away with the paper process of selling bonds. And we're hopeful in 2, 3 months, like you can click and buy a bond, you will be also able to click and sell a bond, irrespective of wherever you hold it and whichever demat account that you hold it. So I hope that answers the question of unless of how to sell a bond. Uh, and similar question, what is the disadvantage of selling the bond before maturity? There is no disadvantage. You might have a cost impact, liquidity may or may not be there. But usually bonds are held to maturity, but can also be sold. And that's how it works. A simple question. It shows bond trading. That's the technical right term on the website. Trading means you can also sell bonds. That's why it's called trading and not only investing. It's buy and sell. Thank you for that. Kapilji, I'll open more questions to you
Yes.
now. What is the difference between rating agencies? Do you want to answer or should I
No,
answer?
no, you can answer better on this, I think.
So there are various rating agencies in the country. We can't really say which is better, but CRISIL, CARE, and ICRA have been longest rating agencies in the country, 15 to 20 years. They are owned, some of them are owned by S&P or Moody's globally. So which just because they have a better reputation than some other things. Can India bonds help in making strategy? I think if your RM can help you making something. Uh, Good question. Difference between debt mutual funds and direct bond investment. Kapilji, to you.
Yes, so debt mutual fund and direct bond investment, again, the basic difference will say the debt mutual fund will create a portfolio for you. So they are going to invest into various types of bonds depending upon their own disclosure, which type of rating bonds they are going to invest. And they'll create a bond to you and serve a bond to you. But when you say direct investment into bond, you can create your own portfolio based on your own risk appetite, based on your own understanding, based on your own liquidity part and the maturity amount. You can create a portfolio directly bonds. So both are the best way. So it's just like equity, direct buying an equity and buying an equity through mutual fund. So that is a vice versa that we can say.
I think I'll just add on debt mutual fund. You have the benefit of liquidity. You're right. You can sell at the NAV. But if you see the history of debt mutual fund returns, they are 6.5, 7. If you do direct bond investments, you can create a portfolio of 9 to 10%. So obviously, what you get in liquidity, you can offset with a higher return. Someone is saying I invested in a security which now they tell me is unlisted. Can you help? Apologies, sir. Online bond platforms are regulated by SEBI. SEBI does not allow us to deal in any unlisted. It's very, very difficult. So, difference between maturity and duration of a bond.
Yes, so
Kapil.
maturity and duration of a bond is simple difference. We can say maturity is the time to maturity. So bond is issued for, let's say, for 10 years. So maturity is 10 years. Duration generally will be less than the maturity period. So in very simple terms, if I say if I invested 1 lakh rupees in a bond, how much time it will take to recover my 1 lakh rupees? So that is a duration that you can say. Very technical terminology, but yes, duration, from the duration we can able to calculate the sensitivity of a bond. And generally, the treasury persons or the portfolio managers, especially of a bond, they try to manage their duration. So, what amount I invested and how much time it will take to recover my investment amount. In simple terminology, we can say for the duration. If anything you want to add, Vishal, on this duration?
No, absolutely. Maturity is when you get duration is a way to calculate expectation of return and when it comes. But I think for an average investor, maturity is the important thing that you should do. Secured versus unsecured, very simple. Secured, like you take a mortgage on the house, right? So the bank says, I'm giving you a loan, but your house is mortgaged to me. If you don't pay, I'll take away a house. So that's a secured loan. Unsecured is when your friend Ashish says, Arey, you know me for so long, give me 10,000 rupees, I'll return it. But I have nothing to offer. Usually, unsecured bonds are issued by large public sector companies like REC, PFC, or large corporates like Tata. They said, Bhai, everyone knows us. We are so large. We're 100 billion, 50 billion company. And they issue unsecured. Secured is always better than unsecured because, you have some claim if some things were to go wrong. And I think it's it's pretty good that you can do. A lot of questions on taxes, Kapilji, so I'll again answer them. Interest coupon has a TDS of 10%. Let's say you get interest quarterly or monthly or annually, but the interest income is charged to your slab rate. You can make capital gains on bonds only if you sell before maturity and the bond has appreciated and it has long-term capital gains of 12.5%. If you buy a bond at 100 and you hold till maturity at 100, there is nothing gain or loss on capital. Again, we are not tax champions. We are just giving you a little bit information that we know, and you should consult your tax advisor. Can you give details of bonds which have failed? Yeah, maybe I'll answer. Yeah, in the past we had Divan housing and yes, and things like that, bonds that failed. But we were a different environment. In 2019-20, India was a $1 trillion economy. A lot of good things have happened regulation-wise to invest, to protect the investor, like regulation of online bond platforms, debenture trustees, what they do. So there's a slight change, in ratings. You get information as a holder. 5 years ago, you did not have any information. In the recent times, I have not heard of any listed bonds that have defaulted. Can I buy through a Zerodha Demat account? Yes. If you on our platform, you don't have to open a Demat account with us. You can attach any existing Demat account, and it's open architecture. Bonds can be bought in any Demat account. So, to you, what is the face value of a bond? Can you explain?
So face value for bond, as per the new regulation of a SEBI, it's a 10,000 rupees when the bond is issued in the market. But yes, you can find some of the bonds are available in the market as a 1 lakh rupees also. That is the old issued bond. But as per the regulation of a SEBI, it's a 10,000 rupees is a face value for bond. And when you see on the websites of the portal, is 500 rupees is the price. So to convert it, yes, 100 rupees as a face value can be given.
Yeah. One interesting question, secured versus unsecured, I've answered. Historically, what is the percent of default rate in India? If I invest in 100 companies, very good. So default rates depend on the credit ratings, right? So just to give you an idea, in US, which is the largest market globally, in India, the bond market is $2.8 trillion, including government bonds. The US bond market is $50 trillion plus. They have a default rate of 3 to 4%, which means 3 to 4% of outstanding corporate bonds will default. In India, AAA, AA bonds have a default rate of 0 in the last 5 years. This data was released by one of the large rating agencies. And the riskier segment, which is a BBB minus segment, the probability of default is only 1 to 2%, as shown. Again, taxes, we've talked about taxes. If someone wants to make a low risk portfolio, which type of bonds are suitable? Convertible or non-convertible? Sir, convertible bonds are equities. They convert into equity, so they do not fall into the fixed income category exactly. But for a low risk portfolio, Kapilji, what do you say? Start with government securities,
Yes,
AAA, AA
start
plus
with
bonds.
the GSEC and AAA.
Yeah. Oh wow! Sorry, there's a compliment. I can't read the name. Saying I'm an oil and gas professional. I've been investing through your platform. Thank you, sir. I keep telling my friends about bond investments and I speak in podcasts. Thank you. I think education and awareness is a little lacking in India, but fixed income bond investment is very big internationally. Once you've made your money, you can't. Where to invest money? Which bonds if you receive retirement PF fund? Sir, again, we are not advisory, but Kapilji, what would you suggest?
So
It's not
again,
advisory.
when you
Don't
say
work.
about the retirement, so we'll not suggest one type of instrument. You have to create your own portfolio. So we have shown how the strategies should be there in a portfolio. You can park some money into the GSEC. So if you want a GSEC with the lock-in period, so there are the FRSBs are there. There are the long 10-year GSECs are there. You can invest into some of the triple rated bonds of the good PSUs where the yield is slightly low, but yes, the coupon will be paid frequently. And again, some part of the FDs you can do from so different diversification. We have shown one chart also. So it's 20% to GSEC, 40% into these triple rated bond and something like that. So you can select the portfolio for that part, but not into one instrument.
Yeah. Another question, what is the difference between ratings like A plus and A? So credit ratings, I'll explain very, very simply. It is like your personal CIBIL score, right? So for an individual, if you want to take loan, People want a high CIBIL score. Now, if your CIBIL score is high, you will get a cheaper loan. If your CIBIL score is low, you will get a higher, more expensive loan. With companies, you reverse that. If companies have a high rating, you'll get a lower interest rate. So difference between A plus and A is small, but there are 10 rating categories in investment grade, from AAA to AA plus to AA minus, A plus. So it changes little bit by little bit. Again, this is not sacred and written in stone. You can have A plus bond giving you sometimes a higher yield than A. That's about balance sheet. That's about industry. That's about the funding needs. A very interesting question. Any state bonds have defaulted any time as they're unsecured? There are two kinds of state bonds. One is state development loans, as we showed, as Kapilji spoke about, SDLs. State development loans are about 50 to 75 basis points more than government securities. They are actually practically backed by the government of India, right? So government securities, SDLs and T-bills are issued by central government and they're called risk-free. They cannot really default. Then on the other side, you have state guaranteed bonds, which means there are projects in states where the state government has said, I will guarantee this project. I'm not aware of any defaults, sir, but I know that there have been delays in one or two state projects. And I think the confusion historically, it's not now, but has come because in the past, the state got divided into two states, right? So then there was confusion because as to who's going to pay and how it's going to pay. So there has been some delay in the history of India in different states, but I don't think anything has default. One person has written, my tax income is low, 15G, 15H companies do not respond. We completely understand your pain. In fact, we've also told the regulators that please try and reverse this because this TDS should not apply to bonds. There is a function on IndiaBonds website where you can, if you actually buy a bond, then it'll tell you, do you want to submit 15G or H? And we'll give you a company email. We'll pre-fill the form for you. I know it's very painful, but we're trying to resolve that issue. But the company has to respond, and we try and help out if you get stuck. What is a senior secured bond, Kapilji?
So senior secured bonds are the bonds when for example, the company got defaults. So the first priority after the bank obligation will be given to the senior secured bond for the outstanding payout, that we can say. So bonds are categorized into senior secured, secured, unsecured. So when we say about the senior secured, at the time of liquidation, first priority will be given to the senior secured bond for the payout of the funds after the bank liabilities.
Yeah. There's a question. I do not understand the question. I'll read it out. For time period 1 to 3, adjusted return with respect to tax is less compared to hybrid gold plus equity. We may consider it as a passive income or something else, like diversification. NSC 5 is tax. So there are various instruments or things like NSC and RBI floaters and things which are a traditional fixed income have a huge lock-in, 5 year, 7 year, 15-year lock-in. If you buy a government security or a corporate bond, even if you buy for 10 years, but you need to exit, you can exit, right? Due to an emergency, you can transfer these things. Other things are not transferable. Bonds, typically people buy for three main reasons, we think. One is portfolio diversification. Do not put all eggs in one basket. Secondly, to earn regular income. You want to match your EMIs, you want to pay for your expenses, and you have some kharcha. And third is fixed returns, right? Because you can sleep a little better at night, especially whether you invest at 7%, 8%, 10%, but you don't have to look at the stock market or any other market every day. So the concept of fixed returns and regular income and diversity are the three main things why I think people should invest in fixed income as compared to traditional fixed income assets. As compared to FDs, it gives you much higher returns and things like that. Can we get statement of account how we get in case of fixed deposit? Actually, on IndiaBonds, if you invest in bonds, you can see a portfolio live at all points of time. You can download your statement of what you bought and how much interest you made for at least the last 2 financial years. And it'll tell you when your cash flow is also coming. So, the system sends you messages that, hello, your interest income of 5,000 rupees is coming in 2 days or 3 days, or your bond is maturing. Do you want to reinvest? So all those features are there, and you can try and do this. Some bonds in secondary are at cheap price. Is it good to buy? I think price is a relative value. Kapil, do you want to take from a concept point of view about price and why is it cheap or expensive?
So price, again, you can see price, if the yield of a bond is definitely high, the price will be the less to the face value, we can say. So bond generally traded par, premium or discount. So when price is cheap, it means a bond is trading at discount. Okay, so if you buy the discounted bond, you have to see the second part of the discounted bond. What is the reason of the discount? It might be the economical prospects or the change in the interest rate. It can be okay, but this discount is due to the change in the rating. So it can be the point of concern that this bond is available at the discount to you.
Yeah, like someone is asking, how does fluctuating interest rate affect bond price? Yes, so inverse relationship, when interest rate goes up, bond price comes down. I think when you say a bond price is cheap, you should see, this comparison, right? Where are other bonds trading in that segment? Where was it before? Where is it now? What is the interest rate cycle? Uh, a question, technical question. YTM is assumed that the coupon is reinvested. I'm very impressed with questions, I must say. Kapilji, you and I have been doing this since 1 year, and we
Yes.
get basic questions now, very, very matured
Very,
and
very mature
very,
question.
very
Yes.
smart questions. So thank you, audience. We really appreciate it. YTM is assuming that coupon is invested at the same rate. But is it the actual return if I do not invest back? Very good question. Maybe I'll attempt or you will attempt, but
Yes, yes.
YTM is very similar to what we call IRR. It's very close to XIRR. XIRR concept does not assume that the coupon is reinvested and you have different cash flows. The difference between the XIRR and YTM is very small. So I know there is 5-10 basis differential. YTM yield concept for bonds came from government securities because you have uh, the correct cash flows are known at all points of time. So it's more nomenclature. You're absolutely right. YTM is interchangeably with XIR or IRR function too. Difference is very small for today's discussion. Uh, what kind of bond portfolio would you recommend for people in the early 60s? Kapilji, do you want to take an attempt?
No, I think that similar question that we have
Yeah.
discussed, but
Yeah.
again, you can create your own portfolio. So we will not
Yeah.
recommend a bond. So
Yeah.
it should be the less risky because you are
Yeah.
early 60s.
Yeah, we think, see, it's natural for an investor in your, and age does play a role. I'm 20, 30, 40, your risk-taking ability is higher maybe because you think you have a longer time to make things happen. I'm not saying 60 is late. I think average age has gone to 80, 90, but really depends on your risk appetite. If you've made your capital, then you want that good 8, 10, 8, 7, 8, 9%, and you should be happy with that. There is a funny concept internationally called the 30-70 rule that at the age of 30, you should have 70% equity, 30% of fixed income. At the age of 60, you should have 60% fixed income and 40% equity. But, these are just famous sayings, nothing, proven as such. There are a lot of discussions on YTM. We will not go through that. There are articles and blogs written on our website. Please visit that. Can we assume state guaranteed bonds like Kerala? We will not go in single names, sir. This is not an advisory function. A double A is a relatively safer rating. As we say, double A to single A bonds yield you between 9 to 10%. And below double A, there are a lot more granularities of rating. So you decide your risk appetite. Uh, Again, a lot of people, thank you for your update on YTM and XIR differences. We will not go in that detail. Again, there's a question on a particular NHI bond. I will not go through that. As a finance fresher, any career opportunities in bond market? There are always opportunities in bond market. The amazing thing is that the bond market is growing rapidly and not many people have experience with it. With bond platforms, there are big bond houses. There are always great opportunities as an analyst, as a salesperson, as all kinds of concepts. So, uh, you rather put your career in things that there's not enough talent in. So good luck to you. Uh, if the bond degraded on credit, is the company pay extra interest? Very good question. There's something called covenants in when a bond is issued, right? So, which means rules under which a company issues bonds. If the covenant has it that if the bond rating is downgraded, you will extra interest, then you get extra interest. There could also be covenants, like, a company said, I will maintain a certain interest coverage ratio. If they don't do that, sometimes we have seen companies who pay 1 to 2% extra till the covenant is corrected. So yes, you have to read the information memorandum. And when you invest in a bond, you can ask that question, what are the covenants about ratings downgrade? But it does happen. Okay, we've got team 5 more minutes. In case you have any more questions, now is the time. I'll just like to repeat few basic things as people will stop. Kapil ji, aapke liye bhi last comments.
Yes.
All we say, thank you. You should invest in bonds. We say, do not buy from unregulated platforms. Do not buy unlisted bonds. You do not have regulatory protection. You might like a lot of high yield bonds, but just remember, just a portfolio of high yield bonds is saying, I have a small cap equity portfolio only, and diversify a portfolio. If you buy enough high yield bonds, maybe you're fine. And again, on a platform, we try to show everything. Any last comments, Kapil ji? Otherwise, we will wrap up this session for
So last comments from my side again, as a part of the portfolio, because this session is on the portfolio. Generally, we have seen into the market. I was sometime before reading on the Mint that one person is invested in the entire corpus of retirement into one bond only, and that was not liquid at the time of the money he was requiring. So please don't put the entire money in the one asset class or one company. Always diversify, because diversification will minimize your risk. And not only the theory of diversification doesn't say maximizing the return, but the minimizing the risk with the optimal portfolio of various asset allocation. That will be always required.
One last one, NCD and bonds, the same thing. Yes, sir. NCD is non-convertible debenture. It is a term used for corporate bonds, and traditionally bonds have been used for government securities, but they are a fixed income instrument. They are the same thing. Do not be confused. NCD and bonds are absolutely the same thing. What is the remedy if I don't get interest on time? Usually interest gets delayed by a day or two, because if the coupon falls on a Saturday or Sunday, we get a lot of clients saying, "Hey, my coupon was due on Saturday, it hasn't come." By Monday, it usually comes. If the company delays interest for anything, there is a remedy period. Your debenture trustee will email and inform you. A company usually reaches out to its clients and tells them what is the reason for that, and hopefully it's not a default. One company promised me things like 1.25 times security. Can you explain that? Kapil, do you want to take it, or do you want me to take?
No, you can take this question, sir.
So all that is saying is that usually NBFCs kind of say you have 1.25 times security. What does this NBFC say? That for every 100 rupees that I have raised, you have a right on my receivables. NBFCs has receivables that somebody is going to pay them. That, for every 100 rupees I have borrowed, I have secured 125 rupees of my receivables to you, or 1.25 times, right? I think that is what it means. Some people have asset cover or receive or ratio saying, for every 100 rupee borrow, I have secured you to 1.4 times a fixed asset or something like that. That's what it means. Again, it should depend on the receivables of ratings of the company who's telling you this, right? So if a AA plus, a single A NBFC is saying it's relatively good. If a triple B minus is saying, which means the balance sheet is a little on the weaker side, is it 1.1, 1.2 enough, or 1.3 enough? I think that's a call you need to take. I think with that, there are a lot of other technical questions, but we come to the end. Principal protected notes, inflation. I think that's beyond the discussion for today. Please type your feedback on the chat on this session, so that as a team, NISM and IndiaBonds, we keep improving it. Shriram, back to you.
Thank you so much for this amazing session on bond portfolio and strategies. To our amazing audience, we hope you learned something new, and we tried answering as many questions as possible today. The full video will be available on both NISM and IndiaBonds' YouTube channels. Huge thank you to Dr. Kapil and Mr. Goenka for your time. Make sure to follow IndiaBonds and NISM YouTube channels and our social channels to stay informed on any upcoming webinars and more such educational sessions. If anything else comes to your mind, feel free to contact us. Signing off for today. Thank you so much.
Thank you, Kapil ji. Thank you, NISM. Thank you, the audience.
Thank you.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.